50 times leverage doesn't mean you can win 50 times more. It means the market needs to move about 2% against you to wipe out your entire position. 2%. That's a normal 5-minute candle on Bitcoin. Most beginners don't blow up their account because they picked the wrong direction. They blow up because they didn't understand the math of the tool they were using. Let's actually go through this properly because almost nobody explains it in a way that makes the danger click before you've already lost money learning it the hard way. Here's the first thing to understand. Leverage doesn't create edge. It doesn't make your analysis more correct. All it does is multiply the outcome of whatever you are already going to get in both directions. If your setup is genuinely good, leverage lets you use less capital to get the same exposure. If your setup is bad or your risk management is bad, leverage just gets you to zero faster. It's a magnifier, not a strategy. The number people fixate on is the leverage multiplier itself, 50x, 100x, and they treat it like a difficulty setting, like choosing hard mode in a video game for bigger rewards. That's the wrong way to think about it completely. The number that actually matters is your distance to liquidation, expressed as a percentage move in price, and that's simple math you can calculate before every single trade. Rough version, ignoring fees for a second, your liquidation distance is roughly 1 divided by your leverage as a percentage. 10x leverage, roughly 10% move against you gets you liquidated. 25x, roughly 4%. 50x, roughly 2%. 100x, roughly 1%. Look at that last one again. 1%. Bitcoin moves 1% in minutes on a normal day, with zero news, zero volatility event, just regular market noise. This is why so many beginners get liquidated on trades where their actual directional read was completely correct. They were right about where price was going. They just didn't survive the normal noise on the way there, because their liquidation distance was smaller than the market's average wiggle room. Let me walk through a concrete example, because seeing the actual numbers side by side makes this land differently than just hearing the concept. Say you have $1,000 and you open a position at 50x leverage, giving you $50,000 of exposure. Price needs to move only about 2% against you before you're liquidated, and your entire $1,000 is gone. Now compare that to opening the same $50,000 of exposure using 5x leverage instead, which means putting up $10,000 of margin. Same market exposure, same dollar profit or loss per point of price movement, but now price needs to move about 20% against you before liquidation, not 2%. Same trade idea, same exposure, wildly different survivability. Here's the part that took me embarrassingly long to internalize. High leverage doesn't let you make more money on a good trade. Your exposure is the thing that determines your profit in dollar terms, not your leverage multiplier directly. Two different traders with the identical $50,000 of exposure make the identical dollar profit on the identical price move, regardless of whether one of them used 5x leverage with more margin or 50x leverage with less margin. The only thing that changes between them is how much room they have before getting liquidated. High leverage doesn't increase your reward, it just decreases your margin for error, while your actual profit potential stays exactly the same for the same exposure size. So why do so many beginners reach for 50x or 100x anyway? A few real reasons, and I've felt every one of these myself. First, it feels efficient. You can open a large position with very little capital, which feels smart, like you're not wasting money sitting as unused margin. But that unused margin isn't wasted, it's your buffer. It's the thing keeping you in the trade through normal volatility instead of getting shaken out by noise before your actual thesis even gets the chance to play out. Second, and this is the psychological one, high leverage feels exciting. There's a rush to seeing a large notional position size on a small account. It feels like you're playing a bigger game than your actual account size would normally allow. That excitement is not a trading edge. It's a feeling, and feelings are exactly what get monetized against you when you're on the other side of a liquidation engine. Third, beginners often don't actually do the liquidation math before entering. They see 50x available as an option and use it without calculating that their stop loss, if they even have one, is functionally meaningless if the liquidation price arrives before their mental or manual stop does. I've seen traders set a stop loss 10% away from entry while using 50x leverage, not realizing their position would have already been liquidated at 2% long before their own stop loss level was ever reached. The exchange's forced liquidation becomes your real stop loss in that scenario, and it's a far worse one than any stop you'd set yourself, because it comes with liquidation fees and no discretion at all. Let's talk about a smarter way to actually approach this, because the answer isn't simply never use leverage. That's not realistic advice for how derivatives markets actually work, and plenty of professional traders use leverage responsibly every day. The better question to ask isn't, how much leverage should I use? It's how much am I willing to lose on this specific trade in dollar terms, and where does my actual invalidation level sit on the chart? Start from your risk, not from your leverage setting. If you're willing to risk 1% of your account on a trade and your stop loss, based on real chart structure, sits 3% away from your entry, then your position size and effective leverage should be calculated backward from those two numbers, not chosen up front based on what feels exciting. Here's the actual formula, and it's simpler than people expect. Risk amount equals account size times your risk percentage. Position size equals risk amount divided by your stop loss distance, expressed as a percentage. If you have a $10,000 account, risking 1% means you're willing to lose $100 on this trade. If your stop is 3% away from entry based on actual structure, your position size should be about $3,300 of exposure. That's it. Notice leverage as a concept barely entered that calculation directly. It's just whatever multiplier gets you to that specific exposure number using the margin you're comfortable allocating. This reframes leverage completely. Instead of asking, what's the maximum leverage available, you ask, given my stop loss distance and my risk tolerance, what position size do I need, and what leverage gets me there efficiently? Sometimes that's 3x, sometimes it's 15x. It depends entirely on how far your actual stop loss sits from your entry, which depends on real market structure, not on how much excitement you're chasing that day. Let's also talk about something that compounds this problem badly, using high leverage during high volatility events specifically. Funding rates, news releases, low liquidity weekend sessions, these are exactly the moments when price can wick violently in both directions before settling. A position size for normal volatility can get liquidated on a wick that reverses within minutes, and you'd have been fine if you'd simply had more room to begin with. This is why experienced traders often reduce their effective leverage specifically around major news events, not because their directional thesis changed, but because their tolerance for noise needs to widen when the market's noise level itself widens. I want to bring this back to something practical you can actually implement this week. Before your next trade, do 3 things, in order. First, mark your actual invalidation level on the chart, based on real structure, not an arbitrary percentage. Second, decide your dollar risk for that trade as a fixed percentage of your current account, not a fixed dollar number that doesn't scale with your balance. Third, calculate your position size backward from those two numbers and only then figure out what leverage multiplier gets you there. If that process ever tells you that you need 50x or higher leverage to hit your intended position size with the capital you're allocating, that's usually a signal your stop loss is too tight relative to your actual risk tolerance, or your risk percentage itself is too aggressive for your account size, not a signal to blindly increase leverage and hope for the best. One more thing worth mentioning, because it ties back to everything else on this channel. All of this math only protects you if your execution actually follows it. I've correctly calculated a position size and then moved my stop loss mid-trade because price got close and I didn't want to be wrong yet, which quietly turned a well-sized trade into an oversized one in terms of actual realized risk. The math is only as good as your discipline in sticking to it once the trade is live and your emotions are the ones sitting in the driver's seat instead of your spreadsheet. Let me also address the fee side of this because it's another place where high leverage quietly costs more than people realize, separate from the liquidation risk itself. Every time you open and close a position, you pay a taker or maker fee on the full notional value of that position, not on your margin. If you're using 50x leverage on a $1,000 account, you're paying fees on $50,000 of exposure, every single trade in and out. Trade frequently at high leverage, and fees alone can eat a meaningful chunk of your account over a month, even before you account for any losing trades at all. This is part of why overtrading and high leverage tend to show up together, and why that combination is so consistently destructive. Lower leverage, sized correctly for your actual risk tolerance, doesn't just protect you from liquidation on normal volatility, it also reduces how much fee drag your account absorbs relative to your actual account size. There's also a subtler psychological trap specific to high leverage that's worth naming directly. When your position size is tiny in dollar terms relative to a huge notional exposure, it becomes very easy to stop treating that number as real money. $50,000 of exposure on a $1,000 account starts to feel abstract, like it's not really your money at risk until the liquidation notification hits, and it very much was. Traders who size positions more conservatively, using less leverage for the same or similar exposure, tend to feel the weight of the position more accurately, which paradoxically often leads to better discipline because the risk feels real instead of feeling like a video game score. Let me also give you a quick gut check you can run on any position before you open it, something I do almost automatically now. Ask yourself if this trade goes against me instantly, right after I enter due to nothing more than normal noise, a wick, a stop hunt, a random 5-minute spike, would that alone liquidate me, even if my broader directional thesis turns out to be completely correct over the following hours? If the honest answer is yes, your leverage is too high for the volatility of the asset and time frame you're trading, regardless of how strong your setup looks on the chart. A correct thesis that gets liquidated by noise before it has room to play out is functionally the same as a wrong thesis in terms of the result in your account. I'll leave you with one more distinction that matters here. There's a real difference between leverage as a tool for capital efficiency, freeing up capital you're not using so you can deploy it elsewhere, and leverage as a tool for chasing bigger numbers on a screen. Professional traders and funds absolutely use leverage, but they size it around volatility and risk tolerance first, and treat the multiplier itself as an output of that calculation, not an input chosen for excitement. That's the entire mental shift this video is asking you to make. So here's the actual takeaway. Stop choosing a leverage number because it feels exciting, or because it's the highest one available on the exchange. Start from your stop-loss distance based on real structure and your fixed risk percentage and calculate your position size and leverage backward from those two numbers. Every single time, no exceptions, regardless of how confident you feel about this particular trade. Next video, I'll walk through exactly how I calculate this live on an actual BTC chart with real numbers, so you can see the entire process from marking structure to actually opening the position. Until then, go check your last liquidation, if you've had one, and calculate honestly whether it happened because your analysis was wrong or because your position size was wrong for a market move that was completely normal and predictable.